Here's something that might surprise you. While most markets were bracing for massive oil production increases, crude prices actually surged over $1 on Monday. Why? Because sometimes in the oil world, less really is more. The drama unfolded when OPEC Plus announced their latest production plans, and traders quickly realized this wasn't the flood of new oil many had feared. Instead of opening the taps wide, the oil cartel's decision was surprisingly restrained, and that restraint sent shockwaves through global energy markets. Let's break down what actually happened. 8 key members of the OPEC Plus alliance, that's the Organization of Petroleum Exporting Countries plus Russia and their allies, revealed plans to boost output by just 137,000 barrels per day starting in October. Now, before you think that sounds like a lot, consider this. In previous months, these same countries were pumping out increases of around 555,000 barrels daily in both August and September, and over 411,000 barrels in June and July. So what's behind this sudden moderation? Ole Hansen, who heads commodity strategy at Saxo Bank, put it perfectly. The market had run ahead of itself in regards to this OPEC Plus increase. Today we're seeing a classic sell the rumor, buy the fact reaction. The numbers tell the story clearly. Brent crude jumped $1.16. That's a solid 1.8% gain, reaching $66.66 per barrel by mid-morning GMT. Meanwhile, U.S. West Texas Intermediate crude wasn't far behind, climbing $1.09 or 1.8% to hit $62.96 per barrel. But here's where it gets controversial. These gains came after both oil benchmarks took a beating on Friday, tumbling more than 2% when disappointing U.S. employment data cast doubt over future energy demand. For the entire week, both crude varieties lost over 3% of their value. Now you might be wondering, why would OPEC Plus choose to increase production at all when analysts are already predicting an oil glut during the upcoming Northern Hemisphere winter months? That's the million-dollar question that has industry experts scratching their heads. The alliance has been steadily ramping up production since April, systematically unwinding years of output cuts that were originally designed to prop up sagging oil prices. This latest decision seems to fly in the face of conventional market wisdom, especially with winter demand traditionally being weaker. And this is the part most people miss. The actual impact of this 137,000 barrel per day increase might be far smaller than it appears on paper.
So when they officially increase production, they're essentially just legitimizing barrels that were already flowing into the market anyway. Toshitaka Tazawa, an analyst at Fujitomi Securities, points to another crucial factor supporting oil prices. Expectations of tighter supply from potential new U.S. sanctions on Russia are also lending support. Speaking of Russia, the geopolitical tension dial got turned up significantly over the weekend. Moscow launched what Ukrainian officials are calling the largest air assault of the entire war, setting government buildings ablaze in central Kyiv and claiming at least 4 lives. This wasn't just another routine attack. This was a statement. U.S. President Donald Trump added fuel to the fire on Sunday, suggesting he's prepared to move into a second phase of sanctioning Russia. This represents the strongest hint yet that Washington might be ready to escalate economic pressure on Moscow and potentially target buyers of Russian oil.
Frederick Lasser, who serves as global head of research and analysis for energy trading giant Gunvor, warned on Monday that any new sanctions targeting Russian oil purchasers could seriously disrupt global crude flows. Think about it. Russia remains one of the world's largest oil exporters, and any disruption to those supply chains would ripple through global markets instantly. Trump also announced that individual European leaders would be visiting the United States on Monday and Tuesday to discuss potential pathways for resolving the Ukraine conflict. The timing of these diplomatic meetings, coinciding with oil market volatility, is hardly coincidental. Looking ahead, Goldman Sachs released weekend analysis projecting a slightly larger oil surplus in 2026. Their reasoning? Supply increases across the Americas are expected to outpace both reduced Russian production and stronger global demand growth. The investment bank maintained its Brent and WTI price forecasts for 2025 unchanged, but projected 2026 averages at $56 and $52 per barrel respectively. But here's what's really fascinating about this entire situation. We're witnessing a classic case of market psychology, trumping pure supply and demand fundamentals. Traders are betting that modest increases today might actually signal more disciplined production management tomorrow. The question that's got everyone talking is whether OPEC Plus is playing a longer game here. Are they deliberately keeping increases small to maintain price stability, or are they simply responding to genuine concerns about oversupply? What do you think? Is OPEC Plus showing market wisdom by keeping production increases modest, or are they missing an opportunity to regain market share while demand is still relatively strong? And here's the controversial part. Could Trump's threat of escalated sanctions actually backfire by driving oil prices higher and benefiting Russia's energy revenues? Share your thoughts on whether this cautious approach to production increases will pay off in the long run, or if we're just setting ourselves up for bigger supply shocks down the road.